Hello to all traders and welcome to the next free live webinar hosted by myself, David Kinley. And this webinar has been brought to you by Orbex. And today we are trading with Harmonics. Now, those of you that usually attend my webinars have seen that we go through a progression of different interesting topics and indicators and just educational topics as well, just to get us more inclined, more up to date with what we are doing. And in doing so, it makes us better trading. So let's just get on with it, right into the action then. So what are harmonic patterns in the beginning? Well, they're specific formations using technical analysis that can help traders understand price action and forecast entry and exit levels. This is very important, and we're going to see a lot of this shortly in the presentation coming up. They're commonly referred to as trend reversal patterns that are based on Fibonacci extensions, retracement levels, and geometric structures. So Fibonacci does play an important part in not only identifying harmonic patterns, but also seeing their progression as well and seeing what opportunities there can be for the trader. Provides a potential reversal zone, which helps to forecast reversal of trades at the brink of exhaustion. So this is very important as well. Reversal, so once a harmonic pattern has developed, has ended, then we're in for a potential reversal, which could see a number of pips being added in the market. And obviously when these buy or sell positions are entered, then we can see what the opportunities are. And finally, it assumes that the trading patterns are repetitive. Once identified based upon the probability that the same historic price pattern will occur, a trade can be triggered. So this is what we're going to look into today. The whole baggage of the trading system for harmonics, and we'll see how we get on. So let's firstly look at what are harmonic patterns. So as I said before, they're based on Fibonacci levels. The basic patterns have 5 points going from X, which is the starting point, to A to B, B to C, and C to D. Excuse me. So I've just put here in brackets, it's where a Fibonacci retracement is drawn. Point C is confirmed when it fails to break above point A, and the finishing point is D after breaking point B, but failing to break this part, the start of point X. Now, this could be a little bit of jargon at the moment, a little bit confusing, but I'll take you through step by step of all the patterns of harmonics, the main popular patterns, and to see where we can go correctly. Also, I just wanted to let you know that because this is a live webinar, I'll be taking any live questions that you may have, and we'll see if any questions are needed as we go along. So the 4 lines connect 5 above points, either in the shape of a W or M, depending if it's bullish or bearish. So the PRZ, or the potential reversal zone, is where the pattern is most likely to reverse in order to enter a viable trade. So here we have X to A to B, B to C, and C to D. And this is for bearish because, as we said before, it's a potential reversal zone. And point D, which is the last leg in the pattern, is the potential reversal zone. And this means that we are looking for a reversal in the pattern. So because the final leg is going higher, it's a bearish scenario because once this has been reached, we're going downwards, and bullish on the M. So once the D has been reached, we are looking to go higher. So just a brief history of harmonics and where did they come from. So Howard Gartley originally laid the foundations for harmonic patterns in his book Profits in the Stock Market, which was in 1935. And you'll notice that Gartley is one of the most popular trading patterns for harmonics that we have. And we'll look at that shortly. In the 1970s, Scott Carney took the Gartley pattern a step further and introduced the concept of Fibonacci ratios in the equation. So Howard Gartley basically did the foundations. He put it in his book. However, Scott Carney added the Fibonacci ratios. And then Carney did discover that these ratios could be applied in an effort to make harmonic trading more reliable. And the 4 main types, and possibly the 4 most popular, are the Gartley, butterfly, bat, and crab. So let's get into them straight away. So this is the Gartley now. Because it's the most popular, I thought I'd start off with a really detailed example of this construction. So we've got the construction rules and how to identify. So this figure is from a bearish Gartley pattern. So if we just go back 1 step, or 2 steps, sorry, bearish. So we're looking at this kind of W pattern here. And then once we reach D, we're going to start moving lower. So this is how we start off with the Gartley pattern. So X to A, because we've got a vast downturn in the market. So we're going to have X to A, and then we've got the pullback, which is support here, and then we're going to start moving higher. So the Gartley pattern is the most common of the harmonic patterns. It's a continuation pattern to help the overall trend to extend the same direction. The first step is identifying the pullback from a sharp downturn in the market, and this creates the first 2 points of X and A. So we've got the downturn in the market, points X and A. We are moving lower, and now we've got the pullback. So how far is the pullback going to be? Well, usually it's roughly about 61.8% of the retracement. Now, what does that mean? This means that we put a Fibonacci from starting from X to A, Fibonacci retracement, and the retracement starts at 100% and it ends at 0%. Because it's a retracement, you just have to think of the word retracement means we are retracing back all the way, well, as far as we can to the 100%. But the A to B leg goes as far as 61.8%. And it is very strict with the Gartley pattern, possibly a few pips here and there above or below, but usually it doesn't go any higher than the 61.8%. Usually, I would say. So as I said here, with the notes, with the little bullet points, the pullback goes as far as the 61.8% Fibonacci retracement of the XA leg. So we've done, as I said, just read that back out for you. So we've gone from X to A, 100% to 0%, and then we pulled it back, and this is the B leg as well. I'm going to show you a live example shortly, because as I was looking at a few charts today, I did discover on a specific symbol or specific instrument that there was a harmonic pattern in place. We'll see that shortly after this example. So we've got X to A, which is just a sharp downturn. This can be any length, by the way. We usually go from a swing high to a swing low. And then we're going to go from A to B, which is the retracement leg. Now, B to C is quite interesting, because now what we do, because X to A has been developed, A and B has been confirmed, now we can put a Fibonacci retracement from A to B. So we're going to go from A and pull the Fibonacci retracement all the way up to B. So once the 68.8% has been reached, the next leg of the pattern emerges, B to C. The endpoint of C can be either, it can fall between 38.2% or 88.6% of this retracement leg. So it's a little bit less strict than the A to B leg here, where it goes approximately to 68.8% usually. So this is where the point usually goes. But for this, we have a little bit of leeway. It can actually drop a bit further down or finish a little bit higher up. I've just put it in the middle just so you can see it a little bit easier. So that's where B to C is made. So now we're looking for a bounce roughly around this area. But more importantly enough, point C never goes beyond point A. So you never see this C leg fall anywhere lower than point A. That's very important. Otherwise, the harmonic pattern will be invalidated. And the deeper the pullback for point C, the easier it is in identifying the pattern. So the lower we go, the easier it is. If we end up at, let's say, 40% up here, it's a little bit more difficult to identify this harmonic pattern. As we go from C to D, another upturn after the bounce at point C. So that's when we've seen support and a bounce. So at the moment, we're waiting for this bounce. We're waiting for the move to higher. But now that we've got it here, we're going to start moving higher. And as you can see, the W pattern is emerging. So point D is confirmed when it goes past or breaks past point B at the 61.8%. And what's important here is the same Fibonacci level from 100% to 0% is used for the X to A leg. So when we went in the beginning and we did the sharp downturn from X to A, it's the same Fibonacci level that we'll use for here. The only difference is we're going to add the 78.6% level in, because it usually, once it breaks past this 61.8%, it will run up to the 78.6% level. So that's what we need to see approximately. And as I said, the same Fibonacci retracement is used for the X to A leg. It's used to measure the 78.6% of the C to D leg. So that's what we are creating at the moment. And the final point in the pattern is D. So we confirm this D leg. So this is also confluent. So it's also the same line, approximately the same cluster area of the 1.272 Fibonacci extension points of ABA. Now, before that gets a bit confusing, because it has been with me when I first started looking at harmonics, what we've done here is we've got a Fibonacci extension. And what an extension is, it's not, we're not going from one leg all the way down to the other. An extension uses 3 points. So we've gone from A point to B, and then back down to A. And this in turn has developed an extension, which we'll see shortly on the live chart. And D is usually goes up to 1.272, sorry. And the extension tool is used to give a stronger indication and confirmation for a reversal. So once we get this cluster confirmed, then that's when we're going to see the reversal most probably. So what we've got here, just to confirm, point D is confirmed when it breaks past the point B at 61.8. So we've broken past the 61.8. And then we're running up until the 78.6 level. But because we want like a better confirmation, like a more solid confirmation, we put a Fibonacci extension in from ABA, and that has given a cluster of 1.272 of the extension. So we'll see that on a live chart shortly. But point D, more importantly, can run up to 1.618 extension as well, but it does not go past the beginning of point X, otherwise it would be invalidated. So if the retracement of B to C leg is 38.2 of AB, then CD should be 1.272. So not to confuse you too much there, but what it's trying to tell you is if there is a 38.2%, so if we finished here at 38.2, then there's most likely more of a push to the 1.272. So consequently, if BC is 88.6, so if we fall down to 88 if we go all the way down here on the BC leg, then CD should usually extend higher. So what it's trying to say is if we finish kind of here for the BC leg, then it will give a shorter leg for CD. However, if we get a deeper correction, roughly about here, then we'll have more of a push higher, but more importantly, not to go past XA. Sorry, the starting point. And then we'll have the reversal to the downside. So speaking of reversals, we are now looking to see where we're going to put our open positions or possibly our pending orders for a sell stop, because it's a sell position. So for investors looking to trade on the pattern, a sell position is open once the reversal is hit at point D. And just a quick reminder that it is for a bearish Gartley pattern. So a trend continuation is assumed once the market moves lower. So once we've hit this point and we start moving lower, we do not expect the harmonic pattern to start moving higher. We expect it to fully reverse and start moving lower. However, take profits can then be added to the order based on the AD Fibonacci leg. So the first take profit is usually the 38.2 retracement of the AD Fibonacci leg. So what we've got here, we've put a Fibonacci retracement in of A to D. So I've started here and moved it all the way to point D. So just a reminder that the whole point of a Fibonacci retracement is because we were retracing, we're moving back to our point of origin. This is the point of origins, this is the 100%, and this is point D, this is the start. So now we're moving lower. So usually the first take profit, we open the price here, we open the position here, sorry. The first take profit is 38.2. If you're feeling extravagant or confident, then usually the next take profit is 61.8%. And this is of the same leg, depending on how confident you are. Obviously, if we get down to roughly about here and we see the price start moving higher, it's probably best to close the position because most probably the market will start moving higher. We've hit our take profit number one. However, if we start moving lower and lower, then most probably it's best to close our position at take profit number two. So this is what you probably see when you're checking it out on the internet or probably trading books, trading manuals. Once all the points have been established, lines between the points can be connected to make it look like a more harmonic pattern. This is where it gets a little bit confusing because all these numbers and figures here can be a little bit too much. So let's just break it down a little bit. So what this means, we looked at a bearish Gartley pattern. And all this means is from point X to A, it can, we've got the downturn leg. Then from point A to B, remember we had this 61.8% that it would go to on the maximum. So let's just go back quickly. So 61.8%, that's what it's indicating there. That's what this number is about from here to here. Then we've got the retracement back down to the downside, and that could fall between 38.2% or 88.6% of the Fibonacci retracement of legs A to B. So it's in 0.382 because obviously it's just times 100 to make it into a number or a percentage. But obviously Fibonacci retracement, Fibonacci zones in general count on 0 point something. So that's what this is about here. And then we've got the point C to D. If you remember, it can move. This is the Fibonacci extension leg, and the 78.6 here was the, just move it back. The 78.6 here was the original C to D leg. So that's what that means, C to D, 78.6. However, we've got the Fibonacci extension of the 1.27 and the 1.618. Sorry. So that's all these numbers mean. It's not to complicate you too much, but it can be very complicated when you first see it. So let's just take a quick look, because I was looking at the German DAX today, and I was seeing from a potential harmonic pattern being into play here. So what we do here, we take from the recent swing low to the swing high, and we'll just roughly put it about here because these looks like a little bit like false breaks. So at the moment, as you can see, it's come up to the 61.8%. So this is the first downturn leg. If you remember, I'll put the presentation on in a second. That's the first downturn leg, and now we've got the move higher. This is the retracement back up to the 61.8%. So this is X to A, and now I've got A to B. Now we're moving down from from B to C, and if you remember, B to C is calculated by going from 100%, this retracement from B to A. So let me just put that back into, so we've got the downturn, we've got A to B, which is the retracement. Now we're looking, sorry, my mistake. We are looking on A to B retracement. So we go back to here, to the MT4 platform. We've got to pull this down a little bit. So now we've got retracement from point A up to point B. So this is where we're going to think point C is going to end. So we said before, due to the pattern, the end of point C can either be 38.2% or 88.6%. So we've got a little bit of a margin here. So at the moment, if we bring it, if we put in 88.6%, let's just put it in here live now. So 0.886, description 88.6. So we'll just add that. So we can actually move down from the 38.2 all the way down here, but as you can see, it's stopped roughly, let's say about the 65%, but so it's in range, it's correct. Now we're moving higher for the final point D. And how do we get the point D? Well, we're going to do a Fibonacci retracement from X to A, which is already on the chart because it is the original X to A point. So 78.6 was it? 78.6. So in this one, what we're going to do is add 78.6. So 0.786 and 78.6, add. Okay, so we're expecting now the final D leg to move up to here. I'm just going to delete this for you because it's a little bit too much of a cluster. So expecting it to roughly be about this area, which is the 78.6 of X to A leg. But to confirm that, we need to also put in the Fibonacci retracement. So we're going to go A, B, back down to A. Sorry, this was B. So A, B, A. And as you can see, we're looking at this, which is 78.6, but it can also fall between 1.27 based on the rules here. So 1.272. And that's how we get our cluster. So it can fall roughly about here. So as you can see, harmonics can work. There are harmonics in the charts that can possibly give you a direction of where things are going to happen. Now for here, for example, if you saw this big downturn, and the market started moving higher, you could have actually put in a buy position up into the 61.8 because you could have been confident that this is a harmonic pattern being developed and the 61.8% is going to be hit. Once that's been hit, we could have put a sell position in to start moving lower. And then when you started seeing the market move higher, you could have put in a buy position, and we can leave that running because we expect it to be roughly going up to the 15,500 mark. This is for the German DAX, obviously, because, you know, going through all the charts, this is the one that I've seen that looks more likely a harmonic indicator. So this can actually work. It's just a case of looking at the charts, making sure that you're confident enough to trade it, and obviously reaping the benefits as well. So don't be too bogged down with these numbers and figures and diagrams, because it is actually quite simplistic. It is actually quite simple. So just a quick look at where to position the stop loss. So we've got our X to A, A to B, B to C, and C to D. Now we're looking for the retracement. Well, the stop loss, as I said, it cannot usually go beyond, the harmonic pattern does not usually go beyond point X, the beginning. So if it does, we can put our stop loss here, because if it goes past it, then it will be broken. And then it will be the harmonic pattern will be invalidated. And this is this Fibonacci extension or expansion from A to B and B to C. And it's usually from here or up until the 3.618. But usually if it does break past the origin of point X, then usually it is invalidated. So just moving on to another example, we've got the butterfly as well. So now that we've seen the previous example of the Gartley, we know kind of what to expect. So we've got the X to A leg downturn, then we've got the pullback. The only thing is we've got different levels for the pullback. So the Gartley was 61.8%. This butterfly can run up to 78.6% of the retracement. However, point B does not go beyond that level usually. So that's the only difference. Now we've got the downturn. Same thing though, it can fall between the 38.2 or the 88.6%. Again, the deeper the pullback for point C, the easier it is identifying the pattern. And now the good thing about the butterfly is it can be more confirmed, because we're going to have two Fibonacci expansions here. So we're going to have from A to X back down to A, and then A to B to A as well. So basically point D is an extension of both X to A and A to B legs. It ranges between the 1.618 to 2.618 Fibonacci extension, and also from this as well. So basically it can range anywhere from here. As you can see, the butterfly does break past beyond point X. That is a very important thing to understand, because the Gartley did not. And having a double extension or Fibonacci cluster at point D gives us more of a clue of the retracement as well. And again, so as in the previous diagram, the final leg of the butterfly is a general guideline. If B to C reaches 38.2% of A and B, then CD could go beyond 1.61. So basically what this means is if we get more of a downturn in here, there can be more of a push higher. If we get a shorter leg here, it can probably end below X or just above it. So this is the whole point of looking at different clusters. And again, like we see all these figures and diagrams here, not to complicate you, X to A is the downturn, A to B means the 78.6% has been reached, B to C can fall anywhere between these two figures, and C to D can go between these two figures or these two figures on an expansion. That's basically all it is. Look at the crab as well. Got some rules here. I won't go through them too much, because we are still, we are just looking at what we are seeing at the moment. But X to A to B, B to C, and C to D. And more importantly enough, D again does penetrate X. So with the Gartley, we are ending beyond wave X, but for the crab and the butterfly, we are going above it as well. And for the bats, as you can see here, we are ending vastly below point X, very, very below. So A and B leg can be traced between 38.2 and 50% of XA legs. So basically, we've gone here, we're going for the retracement, and this can fall between 38.2% and 50% of leg X to A. So like with the other Gartley and butterfly patterns, we've got a single number here. Just go back so it's a little bit easier to see. We've got a single number here, 61.8%, or the butterfly was 78.6%. However, for the crab and the butterfly, so the crab and the bat, sorry, we've got a kind of a cluster. It's not a set in stone number. So we've got a little bit of leg room or leeway, whatever you want to call it, in that zone there. And then we've got B to C, again, like the Gartley and the butterfly, similar numbers. And then C to D, so it can fall between 88.6% of this leg, of A to B leg, or if we're going to go from ABA, a extension, the CD leg can also be extension between 1.618, 2.618 of the A and B leg. So we're going to go A, B, A, like we did before, and that's going to be that. So I've just got a quick question from Mustafa, and he's asking, is it important for the Gartley to be strict on the 61.8? I would say yes, usually it is. It could be a couple of pips higher or lower, but most of the time, the 61.8% is supposedly to be met for the Gartley especially. So just keep that in mind as well. Thank you for your question. As I said, any questions you want to ask me, please let me know. So how reliable are they? As we come to the end of the presentation, I just want to let you know a few pros and cons for the patterns as well. So the pros are they are frequent, they are repeatable and reliable at producing probable Fibonacci setups. Trading rules are usually standard between each pattern using the Fibonacci rules. They're easily to segregate each pattern. Works in all time frames and in all market instruments, and can be used in conjunction with indicators such as the RSI and the MACD. This is important because it does usually work in all time frames. The example that I gave you recently was from a daily chart, but it can also be used in intraday as well. However, let's look at the cons now. So they can be complex, highly technical, and difficult to understand. Hopefully my presentation has made it a little bit easier. However, they can be quite difficult. Training standards are very precise. Looking out for a pattern could mean missing out on a trend. Conflicting Fibonacci zones, retracement extensions can create difficulty with identifying reversal and projection areas, and the potential reversal zone of certain harmonic patterns can be spread over too many pips. So it can get a little bit complicated to identify, to kind of open and close our trades, to make sure that we're getting the best entering and exiting the best times. Like as I said here, if you saw this potential, okay, this is difficult to trade upon because we don't know when we're going to stop. But once we see this bounce on the first leg, the downturn, move higher, we could trade this. Once we get to the 61.8%, we can start trading on the downside. And again, once the market bounces up, we can trade on the upside. So we are, as I said, hoping that this harmonic pattern will be completed. And actually, let's just take these Fibonacci retracements off because I want to show you how these harmonic patterns are then put together. So if we just connect these levels here. So as you can see, this is how we are connecting and creating the harmonic pattern. And there you go, you have your Gartley pattern there. And obviously, if this goes a bit higher, then it's more of, you could say, a butterfly kind of pattern as well. So this is how we identify and hopefully make profits, and obviously take care of our potential losses as well. So that's how we look at it all. So thank you for your attention. I'm going to stay online for a while. I've got a few questions to answer by text. If you need any questions answering, please feel free to do so, and join me at my next webinar, which will take place next Wednesday, which is, I believe, let me just check the date, next Wednesday, which is the 15th of June. And as I said, any questions, please feel free to let me know. And this video will be added to our YouTube channel. And once again, thank you for joining me. This video once again has been brought to you by Orbex, and we will speak again next time. Bye for now.